Good day. If you judged by headlines alone, so far 2023 might have felt as sobering as 2022. 4 US banks fell, alongside one in Europe. There was much angst about debt ceiling drama, anxiety spiked around geopolitical uncertainty, and central banks have signaled that there's more work to do to win the fight against inflation. With the hesitancy to lower interest rates until clear signs of inflation decline are evident, a tighter monetary policy stance could worsen growth challenges in the global economy and heighten the risk of more severe economic downturn. Prospects for more robust Chinese growth have also once again weakened. Factors such as declining global export activity, subdued consumer sentiment, an uneven housing market recovery, and elevated youth unemployment suggest that China's growth outperformance compared to the government's official target of 5% may be more limited than initially thought. The global circumstances present a significant challenge for South Africa's economic growth, especially when combined with local obstacles such as subdued business and consumer confidence, crumbling infrastructure, and ongoing political uncertainty. Load shedding remains the primary risk to SA's growth, which is expected to stay flat this year. However, an improvement in energy supply is anticipated to boost growth to 1% in 2024, 1.6% in 2025. And yet, in spite of all the volatility so far this year, the All Share Index is up 14.8% over the last 12 months, as at 30 June. It is driven predominantly by industrials, with resources having a particularly tough month in June, down 7.6%. This was due to gold and platinum producers that sold off aggressively. It never ceases to surprise me how quickly things can change, with resources having been the main driver of local equity returns during 2020, 2021 and 2022. In fact, all local asset classes have seen positive returns over the last 12 months, with the All Bond Index up 8.2%, property 1.7% and cash returning 6.8%. Global equities, with the exception of emerging markets, have also delivered healthy returns years to date and over the past 12 months. The S&P 500 is up 14.5% so far this year in base currency. That marks the 4th best first half in the last 25 years, with 2013, 2019 and 2021 the other occurrences. Big tech put wind in the sails of the rally, with Apple shares hitting an all-time high of $193.97 on the 30th of June. Positive sentiment then also spread out to semiconductors, cruise lines, airlines, automakers, home builders and hardware companies. On the currency side, the rand weakened by 3.6% against the dollar in the second quarter of the year, strengthening towards the end of the quarter as load shedding lessened. Year to date, the rand was the 3rd weakest performing currency against the dollar, down 11.1%. Only the Russian ruble and the Turkish lira fared worse. So, what's to come? We may not be out of the woods yet, as there are still warning signs of a possible US recession. In spite of its pause on increasing interest rates in June, the US Federal Reserve remains hawkish. Gains this strong are, however, encouraging to see. In the 21 other instances since 1950 that the S&P 500 has been up at least 10% or more in the first half, it's rallied further in the second half of the year, 81% of those times, with the full year up on average 25%. I found the following chart shared by JP Morgan very interesting. It shows the rally in the S&P 500 since the beginning of the year, as it relates to 40 significant events from a market and economic, political, nature, culture and technology perspective. If it illustrates one thing, it's that when it comes to investing, one shouldn't get too caught up in the details of what's going on around us daily, as there will always be reasons to invest or not to invest. The old saying that it's about time in the market and not timing the market always holds true. This, together with a well-diversified portfolio with relevant exposure to all asset classes linked to an appropriate time horizon, is what is going to determine how successfully you reach your investment goals. It is exactly what we have with our multi-asset house view solutions, the MFP focused model portfolios and the momentum focused fund of funds. Returns for the Houseview multi-asset solutions were positive for the quarter, with the funds participating very well in the asset class returns discussed earlier. The weakening of the rand also contributed further to positive performance from a global perspective. All of the funds outperformed their respective peer groups over the quarter, and performance was in line with the peer groups over the last 12 months, as well as their minimum recommended time horizons. MFP Focus 3, 5, 7 and 7 unconstrained were up by 2.19, 2.5, 3.12 and 3.61% for the quarter, and the Momentum Focus Fund of Funds delivered positive returns of 2.25, 2.65 and 3.15% for Focus 3, 5 and 7 respectively. Please remember that returns longer than 12 months for the MFP Focus model portfolios are simulated returns. Also, due to time constraints, the numbers have not been finalized yet, so there can be a slight difference to the official numbers that will be published on the June 2023 fact sheets.